Welcome to the Thriving Farmer Podcast. I'm your host, Michael Kilpatrick. Our mission is to inspire, educate, and celebrate sustainable farming. We believe that you can build a profitable, sustainable farm that gives you true farm freedom. Join us as we talk to farmers, innovators, educators, and entrepreneurs to glean their top takeaways in business and life. This podcast is sponsored by Small Farm University, the go-to resource for gardeners, homesteaders, and farmers around the world. Small Farm University delivers classes online and on demand with training on how to grow crops and how to grow a profitable farm business that serves you, your family, and your community well. Delivered by real farmers with hands-on experience and expertise, it's unique in its approach, using the RIPET method for growing and building a farm or farm business. SFU membership includes access to a private Facebook group and monthly live Q&A sessions where you can get your questions answered and find the support you need. To learn more, visit growingfarmers.com today. Hey, Thriving Farmers, Michael Kilpatrick here with yet another episode of the Thriving Farmer Podcast. And today my guest is Ryan Tansom, who is the founder of Arkona and the Intentional Growth Podcast. He teaches business owners how to view and run their company like a financial asset through the Intentional Growth Framework, fractional CFO services, and strategic planning. His mission is to help entrepreneurs enjoy their work, create wealth, and make an impact. Ryan, welcome to the podcast.
Michael, thanks for having me, my friend.
And did I get the pronunciations mostly correct?
You nailed it. You got it, man.
All right. So you said there was a story behind the name of your business. Let's dive into that real quick.
Oh, it's so nuanced, but okay. So we were trying to come up with the name of our business that we were incorporating in like 2018. And I had bought Michael, probably 70 domains and trying to figure out what we were going to be calling the company. And so I couldn't find any domains that made any sense. And I was talking to this IP attorney, and the guy just laughed at me. I was trying to name a company. He's like, good luck, man. Yeah. So then I was like, so apparently you can't find a domain that's, going to be purchasable, and you can't name anything because of IP rights. And so then we started Googling cool landscapes in the world, and Cape Arkona in Canada came up. And Arkona.io was $19 and no one knew what it meant. And so it meant that we could start fresh and create our own brand. And that's what we did. $19. However, there's a woman death metal rock singer who is named Arkona that I found out
afterwards.
She's got quite the following. And so we always joke around that we're going to have her at one of our company meetings at some point.
That's awesome.
So that is so totally worthless of a conversation, but yes, we don't take ourselves too seriously, I guess.
Yeah. Well, I mean, the name of our farm, our current farm is, we're on Central Avenue. So we're like, well, the farm on Central is the easiest thing to name it. I mean, we did not want to name it after myself, because our last farm was Kilpatrick Family Farm. And after a decade, it came to the point where we did want to sell it. And we didn't want to sell our name. So it made our business way less valuable. And so again, not that we have intentions of selling our current business, but we always wanted to give ourselves that out.
Yeah, you get that option, right? And
yes,
yes. That's a great lead into the whole conversation. I love it.
Yes. Yeah, absolutely. So let's go ahead and dive into, give us a little bit about your background. How did you get started in entrepreneurship?
It was a family business. So probably like a lot of the listeners my dad actually started our family business back in the early 90s, barely graduated high school, went to 90 days in college. He said he ran out of beer money and, mortgaged our house, bought $250,000 of old Panasonic copiers on 30-day terms and never looked back. Scaled the company up to 21 million in revenue. I worked in the business my whole life, man. So, selling copiers, moving things around, in and out of the business, from cleaning to selling to whatever. And then actually when I went to college, I did a bunch of my internships through the business, Michael. And then, when I graduated in 2009, the world was a dumpster fire for a lot of reasons that probably people remember. And I got pulled back in by my dad's GM. My dad had been very distant for the company, Michael. And we had about 115 employees, 21 million in revenue, 3 locations. And I jump in, I swore in my grave I'd never go work for him. I ended up doing it. It's kind of the whole, a bunch of my friends actually had family farms too, the high school or the college that we went to. So they all went back to family businesses. We got to talk a lot about this stuff and pull my dad back in, and we're sitting in the bank in the CPA meeting in 2009. And my dad had been very distant because he was going through a bunch of personal stuff, kept letting the GM run the business on his own.
Okay.
And bad idea. The guy did not have the skills or the same value alignment. A lot of challenges there. But in December of 2009, my dad was sitting in the bank in the CPA meeting. We found out that we lost $940,000 that year. So we had to turn the whole business around. So I spent almost 6 years replacing 60% of the employees, selling 2 branches for cash, building out a new ERP and accounting system, and then building out managed IT services and software automation, rebranding, and turning the whole business around, honestly. No playbook, man. And it was all out of sheer grit and hard work. And anyways, got to this point where my dad and I couldn't get alignment on what we wanted with the business long term. He didn't, I mean, and I know this is probably an issue with a lot of the listeners too, is like, as you're doing generational or you got partnerships or whatever it is, we had different alignment. As like, he wanted more cash and didn't want to talk about the business, and I wanted to pile it all back in to grow. And I love the business. And it went through about 1.5 years worth of conversations, couldn't get alignment, even though we brought in every suit and advisor you could think of. Sold the business in 2014, and have a huge list, man, of things I wish I would have done differently. But that's kind of like the impetus of my story of like, been there, done that, lots of scars and bruises from it, and the list of wish I would have is huge, which is honestly why I started the podcast.
Yeah, to kind of share that. And that's a lot of the reason why we started our educational business, and our podcast was kind of to share, things we learned along the way. Now let's dive. I have a couple questions. So 21 million in selling just copiers. And were you like a physical store that people would come into to buy copiers, or were you selling online? That's a lot of money in copiers.
Oh, dude, right? And like, we weren't even close to the biggest independent in I'm in Minnesota here. So we would sell. My dad started it by selling copiers to other businesses. So I know, based on probably our age, the fact that a copier used to be technology is kind of hilarious, but like literally the sales pitch was, we will double your company's productivity. Because we can duplicate on both sides, and now it's color. I mean, honestly, our logo was a rainbow color because to show that we could print color at one point. But so we would sell copiers to other businesses, and then we would service them. So we would actually, toner parts, all that kind of stuff. So on the 21 million, you'd have a third that was new equipment sales, Michael. And then the other 2/3 that was service contracts and service revenue. And the kind of the metrics behind the business were, it was a sales industry, man. 400 phone calls, 15 appointments, 8 net news. And then you would have 5 proposals, and then 3 closes. And then you'd have 40 grand in revenue every single month with every single salesperson. And we could take a third of that revenue and guarantee it pretty much every single month. And this is before, man, like, I mean, I was starting to work on the online stuff and the online presence, but like, it was before. Like, now with 22 salespeople, we probably could have chopped half of them in half and then done like online content marketing, like you and I are doing, plus then salespeople and account managers, but it was not there yet at that point.
So that's very interesting. And I'm assuming that it got to the point that, because if you go to try to buy a big copier now, they don't really want to sell you one. They want to sell you basically some sort of rental or lease agreement, because they realize that's better money. And actually, like, a friend of mine walked me through, for depending on the business, it actually may be better for the business to go with one of those programs instead of just outright buying these big expensive copiers.
Oh yeah, for sure, man. I mean, like, we don't have to get into the nuances, but like, honestly, out of all, I mean, I'm trying to think of the industries I have not worked in, other than like maybe like in-depth pharmaceuticals and some other like, very obscure ones. But like, the old industry that I came from was one of the most complicated operational businesses, because we sold equipment, like 4 different lines of equipment. Then what you would do, and actually, so like 99% of the people, Michael, don't buy copiers outright. And that's been for like 30 years. And you lease them. And so like, you lease them, sometimes it's $1 out, sometimes it's a fair market value, but it's kind of like renting. And then you would bundle in. So if it's $2,000 a month for your copiers, it's also including all of the maintenance, the warranty, the consumables, and all that stuff. So we'd have to like price all of that on a cost per copy, our whole operational business model.
Wow. Interesting.
Yeah. And then it's funded and financed, and you got labor, you got inventory, parts, you got, I mean, people, it's a complicated deal.
all right. So you did that 2014, I think you said 2000, somewhere on there, you sold the business. What was next for you?
I had no idea. I quit after 60 days because I was sitting in a management meeting and I couldn't keep my mouth shut. I walked right into the CFO's office. I was like, I quit.
When they
Yeah.
basically bought you out and then you quit the next iteration.
60 days later. So when they bought us, we had to fire 60 out of our 90 employees. It was really hard day, paid a lot of taxes, paid a lot of debt off. We owned our building. And this is how, like, I'll kind of just plant the seed, but like, regardless of the business, man, like operations and then stuff like real estate and buildings are separate assets. So we sold our operations, we had our building. And then, so like, I literally, they took our clients, right?
Yeah.
So like, that was what their goal was. But, pretty much I quit because I wanted to figure out what the heck had happened to us. Like, it was like, I spent 6 years, like every waking minute, blood, sweat, and tears and personal financials rolled right into that company. It was a successful 8-figure sale, but like, so much we would have done differently. And I felt like we hadn't designed the exact outcome that I wanted. And it's like, to slog away for 20 years to not have it be optimal was just not okay. So I immediately said, well, for the first kind of the Cliff Note version of the first 3 to 5 years is, I got a bunch of licenses. Like, I went in and I actually ended up doing money management for about 18 months and securities. And then like tried to like get the academics behind like what happened to me. And that's why I started the podcast, and it's been a way better education, honestly. And then I started Arkona in 2018. So it was a lot of like consulting, flopping around, trying stuff. And it really landed on the education and services that we have now, probably similar to the path that you've been on.
All right. So then let's move into Arkona. So what was the thought process behind that? And what does Arkona do?
So the thought process behind it was that I had been working with and friends with entrepreneurs my whole life. That's all I've ever lived and breathed. And I always realized that entrepreneurs, whether it's, you name the industry, man, whether it's farming or whether it's professional services or online, people have a vision. They want some sort of freedom. They want to make an impact. They want to make some money, like all these things. And yet there's a lot of times that there's sticking points about us realizing that vision. And I was trying to figure out what was the sticking points. And then I kept asking people like, what's your goal? What's your goal? And then a lot of times it's revenue, or it's some like, acres farmed, or it's units shipped, or it's people employed, or whatever it is. And I'm like, well, I know that my dad and I had 115 employees. We had 21 million in revenue. And in 2009, we lost 940 grand. And if we would have sold the company, we would have owed the bank money. So who gives a crap about revenue? And I started realizing that people's goals were kind of bizarre or not effective as the end goal. So what I realized is like, hey, most of the people, and I was very ashamed and very kind of timid around like our journey. And then I realized that so many people go through this exit learning way more than they should have in the process. And one of the themes is this, like, I think about I wanted to change how people viewed the business, which is, hey, it's an asset, right? It's got cash flow and it's an asset. And if we grow that asset, we can have more choices to do whatever the heck we want. But we have to understand how it's valued, how to grow that value, how to monetize it to actually better understand it as an asset. So I started, and we built out an educational program too. That was my goal. Like, view and run the company as an asset, do whatever you want with it, right? So grow the value, monetize it, transition it, get out of your role, whatever it means to you to be successful and have it be worth it. So it was an educational program based on 5 principles. And that truly helps people view and run the company as an asset to help them clarify their target valuation, how they want their income to be along the way, and then what they want their role. Like, so if you're running the company as like a CEO or GM, if you want to back out of that and then keep the asset or whatever you want, as far as it relates to your role. So it was an in-person boot camp for a couple of days, teaching people how to do this. And then in COVID, we digitized it. So now we've had like 500 and some people go through the educational program. That led us to creating the fractional CFO services and the financial dashboard, because people kept looking at module 4 and grow value. Like, how in the heck do you have your numbers organized that way? Because it was clear of like, they could see the story of the business, Michael. And truly, like, at the simplest terms, it's like, Michael, if you have various farms, various endeavors, whatever they might be, what if we're sitting here and it's May, in May of 2024, what is your cash position in all of your companies going to be while paying your taxes, while taking the distribution that you want, and knowing that you've got enough working capital, aka cash, left in the business that's tied to funding that future valuation? That's the guiding North Star, man. So like that needs to be how we view all of our decision making.
Yeah. Yeah. Now talk through, because I believe you said that you've got a 5-part framework. Do you want to walk through that?
Sure, man.
Yeah.
So
all right.
Let's this framework, Michael, this has a lot to do with how I like to think. So like, I was terrible at school, man. I was the kid in school when people were like, here, read this. I'm like, why?
Yeah.
And like just constantly asking why. And here's how I start my presentations. And this will lead into the 5 principles. So I pull up this big, huge cabin on like Salt Lake. And I'm like, look at this thing. Who thinks I should buy it? It's like probably $3-4 million. And I get this, oh, do it. And I'm like, all right. What if I were to tell you, I forgot to mention that my twin daughters who are 7 are rolling into 15 years of sports. I'm not going to have any time. Then should you do it? What does everybody think? Oh yeah, still do it. Or, a couple people are still doing that. And I'm like, what if I told you it's going to derail my retirement plan? Well, and then I get a couple people still doing it. And I'm like, what if I told you my wife would divorce me if I bought the cabin because she hates cabins? And then I say, like, how is that any different than when we're sitting down with our entrepreneur friends going, should I buy that other building? Should I buy that company? Should I buy that plot of land? How about the new piece of equipment? Should I give the second generation equity or give them the president? Or should I hire an outside president? We have no context to our decisions because we don't have a clear goal that is truly pegged to what'll make it worth it. So if we have just revenue or just net income or whatever it might be as the ultimate goal, all of those things that I threw out there could completely derail our plan. Like we could buy that other farm, buy the other company, buy the piece of machinery, launch that new product line or offering, and it completely distract us or sideline us from our goal. And the goal should be a target equity valuation that makes it worth it. So with that kind of context, there are 5 principles that help people. So if I were to ask you, Michael, hey, are you going to promote the second generation family member to be CEO, or are you going to hire an outside president? That should go. What's that?
Yeah. Seeing my son is 6. I think I have to wait a while.
Yeah, put it in the trust, man, and let it run. Or any decision.
Yeah. You're absolutely right, because there's so many directions you can go in any business. And I have seen businesses start up doing one thing, and literally within a couple of years, they realize that that's not quite for them. And the business that started off with one name is doing something completely different.
Yeah. Or something seems really cool, man. Like I'm a visionary and like I like to try new things, but like I want to make sure that I'm staying on track to creating the wealth and having the fun that I want to make the impact, right? So it's having that North Star to make the decisions in front of you have context. So the 5 principles, the first one is your vision. What do you want out of the company long term? What do you want out of your stakeholders? So your community, your employees, your clients, your vendors, like what do you want for everybody? What do you want for your role in the business? Once you understand that, you can move on to principle 2, which is what are the financial targets that'll make it worth it for you? And there are 3 of them. What's the target equity valuation that you want? What's the target annual income that you want, regardless of whether you own the business or not? And your outside net worth is just a decision-making framework, because, there are some people that we work with where like, and I know this is huge in the farming community, where like my friend who they farm like 5,000 plus acres down in Iowa. And it's like, there's a lot of assets, but there's not a lot of cash, right? So like, that net worth will impact how much cash that the family needs to monetize. But those 3 financial targets to give the context of the company as an asset, then we can move on to principle 3, which are the exit options. And how can you monetize the asset and how does it impact your role? So whether it's an employee-owned company or whether it's it stays in the family business through estate planning or a strategic buyer, every one of those exits will impact your role and when and how you get your money. So then the principle 3 exit options, Michael, should be viewed through a lens of the first 2 principles of what do you want in your financial targets. So once we have those 3 principles covered, and in the definition of intentional growth, which we define as purposeful action towards a clearly identified outcome. So those first three principles give us our clearly identified outcome. And then principle number 4 is we can grow value, which is growing the equity value of your asset through creating future sustainable, predictable, and transferable cash flow. So I'll say it again. So it's creating and growing the value of your operations through creating future sustainable cash flow that increases the value, because you've got context of what all your decision making. And then principle number 5 is hire the team of advisors that can help you optimize that plan. So you don't have to be the technical expert in every domain like tax or legal or real estate or equipment. So then you're kind of becoming and truly embodying that visionary, CEO, guiding everybody based on your clear plan and the very clear actions you have to take today. It's a whole point of a framework is, where are we going? Are we on track or off track? Knowing that things will change, right? Life will change, the economy will change. And then you can throw that change into your decision-making to say, okay, how does this impact our goal and what we're doing right now?
Okay. Gotcha. And then with that 5th one, the board of, or just the people around you, do you recommend that as like an outside consultant or a board of directors, or how do you recommend building that team?
I'd say it's a combination of your business and your personal. So as a business owner, privately held business owner, we're unique because we have a company that is an asset that, like your CFO inside the business that can see the actual cash flow. You got a bank that's doing fine. I mean, and it's everything's personal guaranteed. I mean, so like everything is cross pollinated back and forth, but you essentially have your business. And so I've got this org chart that I show Michael, where it kind of shows like this hierarchy of like, hey, you got your tax, your legal, your real estate, your financing, your, what was some of the other ones that I had, insurance, where you have personal and business. And the way to get complete visibility into all these different domains. So that way, and I went through this like for the last 15 years. I don't want to be the expert in all these domains, but I've kind of had to, because of kind of like healthcare, man, where like you go to a doctor and you ask for something, they're just going to give you whatever you ask for, because no one's holistic anymore. We're like, we as entrepreneurs need to be the one that are taking responsibility. But there are 2 people that can disproportionately help get visibility. One is the business CFO, who can see inside the cash flow of all of the illiquid assets, whether it's real estate or operation or entities. And then that CFO is then helping and work with the business CPA, the business attorney, the business bank, the business insurance. So that way the entities are set up the right way. And then on the other side, you have on your personal, your wealth manager, which I know they're really difficult to come by, to find someone that actually gets it and isn't just a robot or doing something that's trying to sling products. But if you can find one that understands your business, your personal side, the way I think about it, Michael, is like, if I said to you, hey, what do you want your target equity valuation of all your entities to be in 2030? You're going to have a personal balance sheet that's going to include your personal investments, real estate, and your business equity in real estate. So it's one personal balance sheet in the future. And then you're going to have streams of cash flow coming from various things, right? And they're coming to you, and you're going to get K1s, and you're going to have a tax return. And the question is, what do you put back? What cash flow do you put back in the various entities to grow equity value in the various buckets? And how do you optimize the stream of cash flow and the equity growth? And then you wrap it around with like the estate planning, all that other stuff. But I'd say, like, there's the business and the personal side. And somehow we all need, as entrepreneurs, clear visibility into our cash flow streams. And then where are they going to create what kind of equity growth in our portfolio? And what's the balance and the trade-offs of the reinvestment versus distributions and all that kind of stuff?
Yeah, because I think you was going back to that when you were working on your family business, your dad just kind of wanted to cash out more, but you kind of want to kick it all back in because you want to keep growing the size of the business.
Yeah, and there's a legal issue with that, because what happens is, man, and I have hundreds and hundreds of partnerships I've worked through, is, let's say I was twice your age, Michael.
Yeah.
And I was the first generation or something. It's like, well, if I want 500 grand a year, or let's say it's 50 grand, it doesn't matter. Yeah. And you don't need it, and you want to reinvest for growth, we're obligated legally to take distributions in proportion to our equity percentages. So, like, you couldn't say, well, I don't need the distributions if I want it. because like you have to take it if I need it. So that's where most of this stuff breaks down, is at the very highest level of goal setting, Michael, because it's like no one has identified their target equity valuation. Therefore, they don't know how much they should reinvest today versus not to accomplish a target they haven't identified. And then people bicker and argue about distributions because they don't know how they should reinvest, because they don't know what the return is going to be. And you have people at different ages, different risk tolerances, different needs and wants, and everybody just bickers because there's no clarity.
Yeah. So how do you get a team on the same page?
Figure out where you want to go and why.
Okay. So there's got to be clear. And I'm assuming along the way, there might be some people that leave the bus.
Yeah, man. Well, I bought out my partnership, or I bought out my partner last year specifically because of this topic. And we used our own framework to facilitate the buyout. Cause like, I mean, I'll just tell you, like, he's almost 3 decades older than me. He got a couple more commas behind his net worth than me. And like, he didn't need to take the risks. He didn't need to deal with the growth and the speed that we were doing it at. And we were operationally starting to have challenges. And I said to him, I'm like, man, like, I'm not putting more money back in to keep funding the growth because we're growing so fast. I'd rather use our clients that are our prospects who want to work with us to fund the growth. And we were talking about different offerings. And he was like, well, I'm not, because I want to stay in these offerings. And I said, okay, well, what else do we need to talk about then? Because it's a funding issue. It's not like, I mean, I love the guy and I respect him, but it was like, he didn't want to do that because he didn't need the money and his goal was already met. So like, we used our goal and our cash flow needs as a framework to discuss the operations and what we were willing to do, which made the buyout pretty obvious that it needed to happen instead of years of conflict, which I dealt with a decade plus ago.
Yeah. So you kind of already been through that. So you kind of knew like, okay, here's where we're headed. This is what it looks like. We need to make sure stuff happens now.
Yeah. Cause like, I mean, I'm sure people listening in can relate. We're like, whether you can see it clearly with data or it's a gut feeling, you know whether you're getting further away from your goal or not.
Yeah.
And it's like, okay, well, I'm either going to put this into data and say, okay, how far away am I? And what's really happening by not making these decisions? Or am I just going to continue to have that feeling gnaw at me and my resentment build at the people around me because I'm not sure why, but I know that something's off.
Gotcha. Yeah.
This podcast is sponsored by Small Farm University, the go-to resource for gardeners, homesteaders, and farmers around the world. Small Farm University delivers classes online and on demand with training on how to grow crops and how to grow a profitable farm business that serves you, your family, and your community well. Applying what you learn in SFU could save you thousands of hours and thousands of dollars. And it can save you the agony of costly mistakes some make just because they don't know what they don't know. Delivered by real farmers with hands-on experience and expertise, it is unique in its approach, using the ripen method for growing and building a farm or farm business. Here are a few highlights of what SFU has to offer in its growing library of resources. Find your perfect farm property. Whether you're renting or purchasing, this course guides you through vetting the farm property and determining how or if it suits your business needs. We give you the secret sauce for what makes a profitable farm property and help save you thousands of dollars. Start your farm intensive. Fleshing out your farm idea, craft your one-page business plan, and discover the right funding options for your business. Use our business templates, worksheets, and calculators to figure out the numbers as you go. Farmers Market Success System. Learn how to attract and convert customers by building an unstoppable marketing and business system for your farmers markets. Production Mastery Series. Learn all about growing, harvesting, and drying greens. Learn about tunnel building and take specialty classes such as brand new and very popular Elderberry Masterclass. We include real-life examples and calculators for figuring out fertility rates, how much money you are actually making, and where your profit is coming from. Business systems and marketing courses. Learn about the SFU Ripen Formula for Success, develop your marketing plan, and join in for behind-the-scenes tours of real farm businesses. Learn the systems you need to run your business well and how to hire a team to help you. And learn how you can add value to what you produce to generate even more income with minimal additional time and expense. In addition, members of SFU get access to the Growing Farmer Summits on demand with over 100 sessions of targeted areas of interest to farmers. These annual online events have attracted over 100,000 people from around the world, and they are included in your SFU membership as a bonus. SFU membership includes access to a private member group, monthly group Q&A sessions, and even one-on-one coaching sessions where you can get your questions answered and find the support you need. To learn more, visit growingfarmers.com today. So what would you say to someone who like is in a family business? They feel like, there's a lot of strife, that, things aren't aligned. What advice would you give them to start with?
It's tough, man, because I've been through that literally 4 times with 4 different partnerships. And it's so important to have everybody get clear on what they want. What are their financial targets? And the challenge that I've always had is asking. I'm a fixer, man. That's why I built this business, is I like to fix. And it's the same thing. Like, every spouse knows, like, I should just listen way more.
Yeah.
Instead of fix. And so it's the same principles, Michael. We're like, someone needs to, like, whoever the family members are, lots of family members, or, some families, some not family, is what the heck does everybody want from the business, from their role? Then what is everybody's financial outcomes that they need from cash flow and growth and equity and the timeline? And like, how in God's name we can have any conversations without any of that first is actually just hilarious. It's kind of like, I attribute that, the importance of getting to that clarity, kind of like health, where like, if you came to me and said, I'm not feeling very good, I'm like, well, you haven't slept for 5 days. You're eating McDonald's for every meal and you haven't worked out. I mean, like, of course you're not feeling that great, man. So like, my point is getting that clarity. And I think the biggest challenge that I ran into, which people can probably relate to as well, is I wasn't the one it didn't come off well. Like, if I'm the one forcing my partner to think about this, it's probably being taken as it's not taking it as well as like some sort of realization on their own that they needed to get to that clarity, right? So there's, I guess I would say, clarity, and then whether it's an outside person, a book, a podcast, or something, a training material, like what that person needs to do, they need to do some hard work to get clear on their goals.
Yeah. So it's almost like something like everyone needs to, like, you give a list of questions, go think about it, come back, we're going to have a meeting and work through it.
100%, man. And my favorite example. Oh, go for it.
Go ahead. No, yeah, go ahead.
I was just going to say, like, and people say, oh, that should be pretty easy. And we've got a bunch of these exercises in our academy. And like, this engineer was like, oh, this is gonna be easy. I'm really good at this stuff. And he got to like question 3 out of 4. He's like, this is really hard. It's like, cause it's introspective work. Like, if you got all your, like, my favorite example too, is these are the probing questions. There was this guy, he had a 2nd generation home residential painting business. And it was really big culture guy, big people guy. And I said, what if I handed you a bag of money for $20 million and then I shut down the whole company and then shut down the website and fired everybody? What would you do? His response was, I'm like, yeah, there's your answer, is your grunt. Like, unpack that. What does that mean? What do you actually want for everybody? Same thing with people. Like, do you want to pass on the operations to your kids or not? You know what I mean? I don't know. No one can tell anybody that, but they have to think through that, because at some point there will be a decision tree. And of course, the option is always die in the tractor or die in the corner office. But like, what kind of mess are you going to leave for everybody at that point?
Yeah. So then with that too, I'm assuming like a lot of the transitions from one generation to the next is very hard. And that's one of the biggest challenges right now with most conventional farms, is that we actually not too long ago had actually 2 sisters on that were talking about looking to try to take over their parents' business, and just the difference in vision. And yeah. So that's that biggest, I think that is a huge challenge right now that we're seeing is, I know a farm in Pennsylvania that I don't know if they're still looking for, but for a decade, they were trying to find the right people to take it over. And just very interesting. Yeah.
Well, and let's unpack that, because one of my best friends from college, truly, like, they found 5,000 acres and he's got 4 siblings, right? Is he the 4th generation? I can't remember. I mean, how much land they have and how much stuff, like, they got like probably $50 to $75 million worth of stuff stuff like combines and the tractors and 17 semis and like all this stuff. So there's two issues here. And this is why I built the framework, because I will never tell anybody what to do, man. I mean, I think everybody listening, if you're an entrepreneur, like you probably are taking the crazy risks, personal and financial, to not be told what to do, right? So like,
correct.
let's take, right, correct, exactly. I've eaten a lot of glass and a lot of pain. I've been through a lot of pain just to do what I feel I should do. And so let's take like my friend's example or these sisters where. What's the vision? Like, what do you want from the farm? Is the farm going to be a sustainable farm, or like, what's the goal of the farm? Right. I mean, I watched that, White Oak Farms, from Joe Rogan.
Will Harris. Yes. Will Harris.
Dude, the White Oak Farms. I'm like, man, I wish I could say it like that, but like, is it going to be a farm like that? Or are you going to stay the course? You know what I mean? Like, so what's the vision for the company or the operation? So that's principle one. And then how do you want your role to be involved? So the way I think about this, Michael, is the two questions that are paramount for principle one. What do you want for all of the stakeholders and the vision of the company, regardless of who owns it and regardless of who's running it? Because those are two separate things. You can own your farm and not be the employee. So like, that's why we have to know, what do we want in specific detail for the future vision, regardless of who owns it and regardless who runs it. That's principle one. Then principle number two, what is the target equity valuation of the family, that the primary owners that need to monetize it? And then what's the cash flow that they need forever? And why this is so important is because my friends, like, I know this is in the farming business, and it's the same way with any illiquid asset, which is every business. There's not enough cash flow to facilitate all the buyouts, and not every sibling can be on the cash flow payroll sometimes. We can't afford it. So like, my friend's got all these siblings, someone's selling seed, someone's doing crop insurance. So I mean, you know what I mean? Like, you go through it, everybody's kind of in the supply chain somewhere, but one of the siblings is taking over the job of the dad, of the main operational individual, right? So then everybody else is kind of in the periphery, like helping out and all that kind of stuff. But so here's how I would separate this then is, so then we have who's going to be working in the business and why, tied to what target vision, but then the estate plan should handle the operations and the value of the operations, and then the value of all the illiquid assets. Then you do the estate planning and shoring all that up. That's totally separate from the jobs. And I know in the farming community, it's a big deal in all industries, but like, this kind of notion of you have to work here to get any of the estate it doesn't have to be that way. The wealth transfer happens separately. So, you know, like we have to, we don't want to sell the family farm to pay for the taxes, right? So we need to deal with the estate planning and wealth transfer separately from the jobs. Then we can start getting alignment of how do we want the jobs to line up over the next 5 to 10 years. And then how do we want the wealth and the cash flow to line up based on what we're trying to accomplish?
Yeah. And so, I mean, one of the things I hear a lot of business owners, I've talked to multiple business owners in our community, and their big thing as well, I don't want my kid to get it because he's just going to run it to the ground.
Let's unpack that. Could we do it for just 1 sec?
Yeah, because I think that's a huge problem.
Yeah, absolutely, man. I mean, like, I know you were talking about the baby boomer transitions and stuff like that as some of the people that you're targeting to get into the industry. And that's like every industry, man. And I could get on a macroeconomic tangent for you in a second, but that is a job function. And so I'm going to give a little bit of context on how I think about this. So for I've been at this now for almost 9 years since we sold. And for years, people would call me because of the podcast. I mean, dozens of phone calls every week. Ryan, I want out.
Yeah.
And for so long, Michael, I'd try and solve their problem, just like the cabin story I told you. I have no idea what they actually are trying to accomplish. Like, well, we should do this. And how about this strategy? And how about this? And I'm like, and then after a while, now I'm like, you don't know what you want out of. So now I ask, what do you want out of? Your job that you get a W-2 paycheck for, or your financial asset? And then I say, well, you know what happens is I don't get a lot of people that call me up and go, Ryan, I'm really sick of my mailbox money of distributions from my company that someone else's runs while I sit on the beach in Florida. It's usually Ryan, I want out of the supply chain issues and the inconsistent weather of the different seasons and growing seasons and the commodity prices and, all that. Well, That is the roles and job function of the operations of an entity. So what do we want out of? So back to now the question of second generation will run it into the ground. Okay. Well, let's put first our ownership investor hat on. So the first question should be, so let's say, Michael, you and I were brothers or something. All right. Does the family want to keep the farm operations and the land and the equipment in our portfolio as an investor? How do we feel about the future equity growth and cash flow of these assets as an investor based on that macroeconomic and all these different climate things? Okay, great. Well, let's say we feel really good about it. Now, how do we feel about the transition of our leadership roles? Well, second generation doesn't know how to tie their shoes without our help. Okay. Now, what do we do about that? Well, if we wanted to play the game of private equity, we hire someone else to be the CEO to run it, so we can keep having equity growth and cash flow and distributions as an entire family. And then you go tell the kids to go sell seed or go crop insurance, or if they wanted to eventually become into the operations, have them give a transition or a succession plan to become a job inside the operations. I mean, there's a lot of ways to handle, but I think it's this conflating of ownership and leadership roles that people solve for their K1 and their cash flow each year instead of solving for equity growth in their various assets.
Yeah, absolutely. Now, something that some folks might understand, explain a little bit about equity, share a little, about that principle and why that is so important.
So absolutely. I'll take it from, I'm going to do 3 different layers here. So I'm going to start with just saying that it's about the valuing an operating entity, right? So like when I think about being an investor, investors invest in different asset classes, right? S&P 500 is, you got the bigger companies, the smaller companies. Well, private equity is an asset class. It's operations, right? So you could be in ag, you could be in pharmaceuticals, you could be in retail, you could be in manufacturing, you could be in e-commerce. That's an asset class of private company equity. So, but how that value is driven and how it actually has come to be is through taking the annual cash flow, which in my world is a lot of normalized EBITDA, and real estate would be like net operating income. But like you have the annual cash flow and you times it by a multiple, which is this number. Most people think this number is made up, but essentially if it's a multiple of 3 to 5 or whatever the range might be, 3 to 10, whatever it might be, is that it's effectively the number of years of cash flow that a buyer is willing to give someone based on the risk of the future cash flows. So if I gave you a 3 for your operations, a multiple of 3 on $1 million in cash flow, that's a $3 million enterprise value.
Gotcha.
For some reason, I don't feel good about the story about the cash flow in years 4 and 5, which is why I didn't give you a 5. Right. But if someone gives you a 5, it's more sustainable. And what happens is the $1 million times the 3 equals 3 million, but that's enterprise value. It doesn't take into consideration the debt people have. So when I say that my dad and I had a 8-figure enterprise valued company in 2009, we did, but we owed a crap ton of money to debt and to taxes. So it's like my house that's worth $500,000. If I owed 900 on it, that's a problem. So the equity is just like I'm talking about with your house. So it factors in your debt. So that's why I think it's important, instead of just having the enterprise value of the operations as the main target, because you could hire a president, they could finance their way up to a huge enterprise value.
Yeah, you just keep, but then the problem is you're very, very over leveraged.
Exactly. Yep.
Yeah. Cool. What would you say if you had to go back and do it all over again? What advice would you give?
Say, Corey and Ryan, go take this stupid course called Intentional Growth so we can actually have a mature conversation and get to clarity behind all this stuff. Because and I shouldn't have said stupid. I mean, I was like, the conversations was the proverbial Groundhog Day conversation every week. He wanted out. We didn't understand all the stuff we've talked about so far, Michael. We didn't have any of these, what I call quote unquote tools, or like ways to talk about this stuff together. It would be, I want out. Okay. Well, I want to keep growing. Well, I don't want to reinvest. Well, I mean, it's just this back and forth, but like, and I'd sit down and go like, I know there's got to be a way to get us aligned, but like for some reason there isn't, because we didn't have the tools to talk about it. So it was just like, I mean, my dad and I are still best friends and talk all day. I mean, we work together still in various fashions. So like, it wasn't like we hated each other. It was just like our timelines, our visions, and our financial needs were different, obviously, because we're different ages.
Well, I mean, that was like my dad technically was the signer on the LLC when we first did it because I was too young. I was under 21. So, and we just did not agree. And eventually the one day he just signed it over to me. And again, he never really started the business to start the business. He started the business for me.
Yeah, to lift you up, which is awesome, man. And if you think about if the company would have gotten big enough, let's say you guys were 50-50 and you wanted like, and this happens actually, it's like a lot with the younger people. I mean, dude, I got twin daughters, right? I need more cash flow today to manage my life. Yeah. And as people are empty nesters, they want to reinvest for distribution or for equity growth. Yes. So it's like, if you and your dad were still 50-50, you have to figure out the cash flow distributions first, because it has to be done legally in the proportion to your ownership.
Correct. Yeah. And basically he was very conservative and cautious. And I was, hey, I wanted to go get some financing and grow the business. And again, I love my dad and he signed it over to me and he just kind of let me do my thing. And it's just, you're right. There needs to be that alignment on, and we had just different ideas about how it was going to work. And neither way was wrong. Well, let's pull that through. You're spot on, man. And like, neither one of you is right or wrong. It's just you're sharing an asset that has needs for funding and for distributions and for some sort of perception of growth. Yeah. And everybody that is working with other stakeholders on the capital table, on the ownership table, has to be clarified. Otherwise, all of the conflict is going to be some sort of derivative of the lack of clarity. Absolutely. Well, Ryan, I know we've been going for a while. Appreciate your time today. Give us a little bit. Where can they find you and your podcast?
The website, Arkona, ARKONA.io, is the repository for everything, man. We got videos on the training, on the podcast. There's 355 episodes of the podcast. I'd say that the best place to get started on that is very similar to kind of what you've got on your website, Michael, is we got a intentional growth financial scorecard. So like all the topics we've been talking about, people can get a score on how well they're viewing and running the company as a financial asset. And there's 4 sections in that. And so it's like 20 questions. It takes less than 2 minutes. And then they get a customer response. And then there's 4 videos where I'm walking through a case study in these videos. So showing what good looks like. So it kind of gives people like, hey, this is what's possible. It's in a spreadsheet. So it's not like hocus pocus. So I'd say that's the best place to get started. And you can find me on LinkedIn or on the website.
All right. Very cool. Yeah, I'm definitely going to head over there, take that scorecard. We've got a couple businesses and I'd really like to get an idea of where both of those are. And no, you're absolutely onto something here. That's a much needed in any space, just to really understand that. Cause I think folks just do not realize where they're headed and they don't just have a plan for where they're supposed to be headed. And so they just kind of like go with the normal flow. And a lot of times it's really frustrating.
Agreed, Michael. And I'd say this is for buyers and sellers, a way of thinking about this, because for people that want to go in and buy it, someone that's a baby boomer that's retiring out of their farm, and like, what happens is I've got the second generation people that are going in saying, helping the seller figure out what they want so they can actually facilitate the buyout. So there's this is the greasing the skids on this decision making, I think will make every marketplace more effective.
Absolutely. All right. Well, I appreciate your time today. Thanks so much, Ryan. And we can't wait to air this.
Yeah. Thanks, Michael. I appreciate it.
So there you have it, another episode in the books. So I'd love if you would hop on over to iTunes and leave us a rating and a review. Those mean everything to us. We love to hear what you're thinking. If you have a podcast guest that you can recommend, please pop on over to the Thriving Farmer Podcast website and leave us a review. That's thrivingfarmerpodcast.com.